It's 2026. Welcome to the new year. Today's episode, we're going to talk about all the things that you should be doing to set yourself up for success to have a fantastic year ahead. I'm Brad Lineberger, certified financial planner.
And I'm Matt Callahan, certified financial planner. And this is Navigating Retirement.
All right, Matt. Well, I'm really excited for the year ahead here. I think there's a lot of great things on the horizon. In today's show, we're going to talk about all the things that people should be doing to really set themselves up for success financially in 2026.
Absolutely. I mean, all these people with the new year, new you, they hire their, workout coach. Maybe it's time to take on a financial coach.
Right?
Yeah.
This is my favorite time of year too. I like to set goals. Everybody's got, we're optimistic that we're going to accomplish our goals. We're going to talk about how to set up a strategy to make sure that you accomplish those goals.
How many of these goals are the same as last year's goals?
I always have one or two. Lose those 5 pounds. Yeah. Be kinder to my kids.
Yeah.
They somehow appear every time.
Yeah.
Okay. So for those folks who had any sort of earned income last year, if they qualified, it's not too late to make an IRA contribution for 2025.
That's a good point because a lot of people miss this opportunity. So you can do an IRA or Roth IRA contribution up until April 15th of 2026 for 2025. And so even if you can't max it out, I would still recommend doing it for 2025 because who knows, you could come into some extra dollars for 2026 and that at least buys you the opportunity to fund 2026 down the road or into 2027. So fund it. Use a prior year or current year and figure it out that way.
Absolutely. Don't let that one pass. And for those of you that are still working, this is a great time of year. Make sure that you've adjusted your 401k contributions, your retirement contributions to keep up with the new standards.
Yeah. So this one always confuses me because the government wants you to save money and save enough for retirement, but they put limits on the contributions that you can put into this. So for 2026, you're actually able to increase your contributions to your 401k or your qualified plan of $24,500 if you're below age 50, and then an additional $8,000 if you're 50 or over for the catch up. And then I believe the super catch up stayed the same, right? So $11,250.
Right. So if you're say in your 50s, you could get $32,500 in. That's a nice chunk of change. New for this year that you should be aware of, if you're a highly compensated employee, and I believe that number is 140,000, the catch-up contribution has to go into the Roth component of your 401k.
Oh, that's a huge one. That's so you need to be, doing some additional tax planning this year if you find yourself in that boat because you're no longer going to get that extra tax deduction for the contribution.
Right. And the IRS, could they make this any more complex or complicated than it is?
So they can pay themselves the big bucks with all the complicated rules.
Right. But, on that note, I think we had the passage of one big beautiful bill last year, and our view on it is tax rates are really on sale. Even though they said that the tax code is now permanent, we think that we've got maybe 4, 5, 6 years of this before another future Congress changes it. So taxes are on sale.
Yeah, they really are. I mean, so to say it another way, we have the 10, 12, 22, 24 in place for the next several years, and they were supposed to sunset this year, and the 12 was going to 15, 22 was going to 25, 24 to 28. So just like you said, I mean, everything's on a discount. You're saving 3 or 4% by maybe doing Roth conversions this year or just to take advantage of that extra low tax bracket.
Absolutely. So, we were talking about the 401k, and for highly compensated employees, the 8,000's got to go in the Roth bucket. That's maybe not the worst thing in the world because tax rates are lower than where I think they're going to be in 10, 15, certainly 20 years.
Right. Oh, and jumping back to, we did forget, we gave the numbers for your qualified plan, but for IRAs or Roth IRAs, your contributions increased as well. So below 50 is 8,000 into your IRA. And then get this, 1,100 for the catch up.
They don't make it why couldn't it be a round number? $1,100. Okay, well, that's the IRS for you.
And so, I mean, these are the things that you have to have earned income to contribute to. So keep that in mind for this year. And some people think you can max out your IRA and your Roth IRA. That's not the case. You can do both, but the total between the two is that 8,000 or the 9,100.
Right. Okay, so another really smart thing to do for 2026. Max out your health savings account. We love those accounts.
So you know what Microsoft tells me the HSA is, right? It's the has account.
Oh my gosh. All right. Yeah. Try typing in HSA and it's going to autocorrect it every time to has. What's this has account? It's an
Um,
HSA.
yeah, if you're tech savvy, then you can actually create a rule and it'll switch it back. But yeah, for whatever reason, Bill Gates wants us to have has accounts.
Has accounts. I love my has account. It's triple tax advantage. You get a deduction for putting money in the HSA. It grows tax free. And as long as you use it for qualified medical expenses, it comes out totally tax free. But what we like to do is recommend invest your HSA account, grow it. Don't touch it. If you go to the doctor, pay out of pocket, let that HSA grow, and you could consider using it for future long-term care expenses when you get older.
Well, here's another planning opportunity is if you can, if you're fortunate enough to pay out of pocket, yeah, invest those dollars, let them grow tax free. The HSA account is the only one that allows you to reimburse yourself in future years. So you could invest the dollars for 5 years, let them cook and grow for you, and then keep good receipts, and you can reimburse yourself at that point.
I love that strategy. Let the markets work for you. Okay, so contribution amounts for your HSA: 4,400 for single, 8,750 for a family plan.
Yeah, and then some people will get scared about putting too many dollars in there because, like you mentioned, that if you don't use it for qualified medical, then there is a 25% penalty. But just know when you get to age 65, you're able to use those dollars for anything. It doesn't have to be for medical, but the taxes are more like your 401k or your IRA. That's taxed as ordinary income, but no penalty.
Yeah, absolutely. Okay, so here's another really good thing that you should be doing this year. And it's, you're not going to like it. It's the dreaded B word, but it's work on your budget. It's review your expenses. And I think this is a great time to do it. We now have a clear look at 2025, and the technology out there today makes it so easy. Go to your bank, go to your credit card, whatever financial institutions you use, and run a trailing 12 report of what did you spend last year.
Right. And I think all of them have that nowadays, but I've even heard people uploading their statements to Chat GPT or things like that and asking it, hey, what am I spending money on? Can you put together an outlook of the last 12 months and do it that way
Oh,
too?
I know what chat's going to say. What are you doing on Amazon? What are you doing at Target?
Well, Gabby knows the Amazon delivery guy, my wife, like my first name. It seems like we get a package every day.
Yeah, but however you choose to do it, we think this is a really good year to just reflect, just take a peek. What did you spend last year? See if there was any anomalies. And why that's important is you should be adjusting your financial plan in real time to keep up with your lifestyle trends.
And I always like coach people just, hey, let's be honest in this area. This is really the tool available to help us make those good financial decisions going forward. I mean, we've all heard the saying garbage in, garbage out. If you're not honest with yourself about the spending, it could be derailing you on other things later in life.
Absolutely. So don't be afraid of it, but this is a good time to tackle it. Okay, so a lot of changes to the tax code based on one big beautiful bill last year. This is a good opportunity to start taking advantage of those changes. One of which is the state and local taxes, which had been capped for years at $10,000. That's now going to be at 40,000, which means more people are most likely going to be itemizing this year instead of taking the standard deduction, which means charitable contributions are going to come back into play. So be keeping really good track of those records and receipts because odds are you could be itemizing again.
Well, good news too for the people that are taking the standard deduction. With the one big beautiful bill, they introduced the enhanced senior deduction. So if you're 65 or older, you may be able to take advantage of an additional $6,000 each, so another $12,000 over the standard deduction.
And so pay attention again, kind of tying back into that budget. It's going to be tied to your income. And so if you're married filing jointly making less than $150,000, you can take full advantage. Both of you guys can get the $6,000 for a total of $12,000 extra deduction. It starts to get phased out at the $150,000 mark. It's totally phased out at $250,000. So again, have that awareness of your income for 2026, knowing that you can get this extra deduction. That piece is not permanent. I think we've got a few more years of this.
Right. So that being aware, like financial planning opportunity is if you're doing Roth conversions, just be aware that you could be reducing that enhanced senior deduction if you got to play the income game.
That's right.
Yeah.
And have a tax strategy in place.
But also for this year, in 2026, if you are taking the standard deduction, you can take $2,000 married filing jointly, giving to charity and get a deduction for that.
I love that.
Hmm.
So, what happened with Tax Cuts and Job Act is the higher standard deductions meant those that are charitably inclined. Now, granted, we're not giving money to charity or church because for tax purposes only. We're doing it for other reasons. But it is nice to get a tax deduction. And to your point,
Hmm.
you can now, if you're married, you can get an extra $2,000 extra deduction. So, so keep the donations going, but then keep good
Hmm.
records
Right,
is the
of
point of
course.
that. Yeah. Okay. Um, okay. So Matt, 2026, your opinion for those folks that are still working, what is better, making pre-tax contributions or post-tax Roth contributions to
I
retire?
mean, loaded question for sure. It really depends on what you're trying to accomplish and what your overall plan looks like, tax brackets, of course. But I have to tell you, like we mentioned earlier in the show, these tax brackets being, relatively low, and we think they're going higher in the future. I've made the switch to all Roth. I'm biting the bullet now. I think it's more valuable. I mean, over and over again, believe it or not, we're running into people that did the right thing, saving into their pre-tax dollars, but now they're running into required minimum distribution
Right.
issues, which is causing them to go into higher taxes potentially in the future. And we don't know what those tax brackets are yet. It could be increasing their Medicare surcharges, so IRMA penalties, extra premiums for Medicare.
Right.
I mean, so I'm practicing what I'm preaching because I've been telling people I used to think the 22 and the 24 were gray areas, and maybe start splitting your contributions between the two, pre-tax and Roth. I mean, in those areas, I think it's relatively cheap from where I think we're going.
Absolutely. Yeah. Taxes are on sale, at least
Mhm.
for this temporary time period. We are seeing people who were middle class Americans and, to your point, did the right thing, saved money to those pre tax 401ks. They were in the, say, call it the 22, 24% bracket. We're seeing those required minimum distributions really spike them later in life up to the 32, 35, 37% bracket.
Yeah.
Right, which is painful.
Hmm.
So to your point, with tax rates where there are, I think those Roth contributions could make a ton of sense.
And I mean, so also going into a strategy for 2026, maybe this is the year you start putting dollars aside into a brokerage account in addition to set yourself up for
Right.
retirement down the road, to do Roth conversions, to have the cash to pay the extra taxes during your gap years, to free up some of those RMDs or reduce the RMDs.
I love those tax. They offer you such flexibility, so you could be living on those while you're doing Roth conversions in those gap years to try and lower your future RMDs. And I think that's a great strategy to think about in 2026.
Hmm.
If you've got the taxable brokerage account and you're in a low bracket because you're retired, start doing conversions all the way up to the top of the 12% bracket for sure.
Hmm.
Maybe, arguably, maybe even into and up to the 22% bracket. And that's where you need to have a multi-year tax projection done. Not hard to do. Go work with your advisor. They should
Hmm.
be able to do it for you. But they can answer the question, is there value in doing conversions even up to and into that 22, maybe 24% bracket?
Yeah, just be aware that when you're going into the 22 and 24, we are adding additional tax or premiums to your Medicare. But to
Right.
your point, I mean, that could be pennies as opposed to the dollars that you're saving in the future.
Yeah. So speaking of Medicare, the 2026 Medicare IRMA threshold has been announced. It's $218,000. So if you're on Medicare, your modified adjusted gross income, if it's below 218,000, you're good. You don't have to
Mm.
pay anything over your base premium for Plan Part B and Part D. But once you go over 218, now IRMA, basically a surcharge or a Medicare tax, kicks in and you start having to pay more for your Medicare.
Mhm.
It can get quite expensive depending on the income. So just pay attention.
Right, and those are per person per month numbers. So if you're both Medicare age, then that's something to be aware of there.
Yep.
So I guess question for you then, we've talked about Roth conversions and RMDs in the future and people being charitably inclined. What's something that people can consider if they're age 70 and a half?
Oh, I love QCDs,
Mm-hmm.
qualified charitable distributions. So, what these are is if you need to take money out because you're being forced to because of that required minimum distribution, and every dollar that comes out of your IRA is taxed as ordinary income. You can lower that tax. But we're seeing this where people are being forced to take out more because Uncle Sam wants his tax. He wants his pound of flesh. Um, so if you are being forced to take out more than you even need to spend in a year, A QCD allows you to take money directly from your IRA and send it right to the charity or charities of your choice, and it's not taxable to you. So, especially if there's anybody out there that's already donating or giving, you might as well flip your strategy and do the donations in the form of QCDs.
Hmm.
The key on this, guys, you cannot hit your bank account. It's got to go directly from your IRA directly to the charity of your choice. But if you do it right, you can save yourself some dollars in taxes.
You can save yourself substantial dollars. I mean, for 2026, you're able to do 111,000
Right.
as qualified charitable distributions. And so if both you and your spouse are of RMD age, you could do 222,000. And so, I mean, that's a huge tax savings if you're fortunate enough to give that amount.
Well, and you touched on it a moment ago. I think it's so interesting. You can actually start doing the QCDs at 70 and a half, which is now sooner than the new RMD age, which is 73. And for anybody born in 1960 or later is 75. So the question is, well, why would I do a QCD before? It's because you need to do a multi-year tax projection. You need to look at where RMDs are going to take you in your late 70s, early 80s, late 80s and if you're going to have a problem, like we're seeing a lot of clients have, get ahead early with these QCDs to start to lighten the load, that and or the Roth conversions.
Yeah, you said it perfect. I mean, because the RMDs are determined based on the account value. So if you're starting at age 70 and a half, when you don't necessarily have to take dollars out, reducing the account value is going to reduce the required distributions then.
Yeah, absolutely. But you just need to have a plan. And so this is the year. If you've never done a multi-year tax projection, this is another thing you should do in 2026. And there's great software out there. Ask your financial advisor. They should do it for you in a heartbeat. But you got to do this because you'll start to understand if some of these strategies that we're talking about make sense.
Well, speaking of giving to charity, I mean, we also want to gift to our family and friends if need be too. So this year, the yearly gift exclusion is 19,000 again. So, or you can gift split if you're married filing jointly, you can double that up and give 38,000. So $38,000 to each person. I mean, this is some pretty significant dollars with not having to worry about taxes on your side or the recipient.
Well, we hear this a lot with our clients. One of their major pain points is, I want to help my kids. As in particular, I want to help my kids buy a house because the housing market's so expensive. So to your point, a husband, wife with a son or daughter who's married, you could give 38,000 to the child. You could also give 38,000 to the spouse. You could effectively get them $76,000 without counting against your lifetime exemption. Now, if you wanted to give more than that, you certainly can, because the lifetime exemption, the estate tax exemption, has also increased for 2026 all the way up to $15 million, and that's per person.
Right.
So a couple who's married could essentially gift $30 million without their kids having to, or their heirs having to pay any sort of estate tax.
Yeah, and that same rule of thumb goes for the generation skipping tax too. So maybe not having to worry about that until you get to some substantial dollars.
Yeah. So if you do need to gift more than that 19,000 per person per year number to stay under the radar, if you have to gift more than that, it's okay. You can do that. There's no tax to the child or to the beneficiary of this. There's no tax to you either. You just have to track the gift, and you're going to use Form 709. And 2026 with the $15 million per person exemption amount, hey, it's a great time if you want to help out family members. We see it a lot. People say they like to watch the joy that the giving produces. They'd rather give while they're alive rather than posthumously.
Yeah, and if you want to gift as well too, if it's coming out of your brokerage account, maybe you have some significant gains in there. You could gift shares that are highly appreciated to the kids, and maybe they're in a lower tax bracket than you, and they can realize those gains at 0%.
Especially after the run we've had in the markets the last 3 years, this would be a great strategy to consider in 2026, especially if you're trying to help your kids buy a house.
Right.
Yeah. Okay. Okay. So let's talk about it's another one that's so important, often overlooked, but it's a good habit. It's a muscle that you need to develop, and that is review the beneficiaries across all of your accounts.
And you can't say it enough. I mean, this is one thing that gets overlooked more often than you think. And life changes. I think it should just be an annual review. It's easy to just make sure, okay, yep, this is right. And yeah, every year kind of thing.
Absolutely. So it's going to be all of your IRAs, all of your 401ks. Make sure look at your bank account to make sure it's titled correctly. For sure, your life insurance accounts if you have life insurance policies.
Hmm.
But on the bank accounts, this is the one that gets overlooked. My preferred way, I'd rather put the bank account in the name of your trust because the trust is going to really spell out who gets what.
Hmm.
But sometimes people are forgetting to do that, or they're not really setting up their bank accounts correctly. So just take stock and review. And the other thing on your IRAs and 401ks, add a contingent beneficiary. So a common example will be husband, wife, they'll make each other the primary beneficiary. But what happens if you both die in a car accident or a plane crash?
Hmm.
Naming the kids as and I'd prefer to see people name a person as the contingent rather than the trust. That's assuming that the child is capable of making financial decisions. It's just much cleaner. It's more tax efficient. It's just easier to do it that way.
Yeah, I like that strategy as well.
Exceptions to the rule would be if you've got a minor, a really young kid who couldn't handle it, or you have an adult kid that's just terrible with money, or maybe they've got credit issues, or they've marital problems, or something like that.
Hmm.
That's where you could consider having the trust as your contingent. But barring those outliers, I'd rather see a kid or a person, I should
But on
say.
the qualified accounts going back, just make sure that if you name your trust as beneficiary, that it has the right language in there to further delay the taxes. You could run into a tax time bomb if it's not written correctly.
Yes, it needs to be a conduit IRA trust, and a
Hmm.
good estate planner knows exactly what that means, and they can set it up correctly. But if your trust is old and you haven't had it reviewed in a while, that brings up our next point. Really good idea to just put your eyes on your trust and your estate planning documents to make sure that they've kept up with the changes that have happened in your life. I mean, how many times have we seen it, Matt? We're going through trust with people and we're reviewing it, and they're like, "Oh, that person's not
I
alive."
don't talk to this person anymore. They're no longer with us. Uh-oh.
Yeah.
Yeah, so a lot of mistakes. I mean, sure that it's okay, easy thing to just double check, make sure that you're setting yourself up this year.
Yeah. So this is a great time of year. And then speaking of that, one of the things, rebalancing your investment portfolio is so important. We talk about it every year. And I always tell people, look, the right time to rebalance is on an as needed basis. But
Mhm.
most people don't have the tools and technology to manage their investment accounts, to say the way that we would as professionals. If you're doing this on your own, pick once a year. And I always tell people either the end of the year or the beginning of the year is a great time. There's no science to
Mhm.
that, but the studies show that once a year is enough to really do it right. So if you listen to the advice but didn't carry it out at the end of the year, now's your second chance. Go ahead and rebalance the portfolio. And we talk about it all the time, but with the run that the markets have had, a good opportunity, get back into the international investments if you haven't
Mhm.
yet. If you have and your international investments did great, trim those. So it's time to rebalance.
Yeah, perfect timing. And then another thing for 2026, if you had a child in 2025, you can take advantage from the One Big Beautiful Bill, the Trump bucks. I think it's $1,000 to any kid, right? Yeah.
Yes. And the strategy there is you can set up these accounts. And then when the kid turns 18, you could do a conversion
Hmm.
to a Roth. So essentially, it's a way of funding tax-free dollars to the kids.
As of right now, I don't know the operations to get that open. I think from what I'm hearing is something maybe through treasurydirect.com, but we'll get more info and release that as things come out.
As that comes out.
Hmm.
Yeah. Um, okay. So the next thing, 2026, I think people need to be paying attention to interest rates.
Hmm.
So if you did take advantage of when rates were low back in 21 and early part of 2022, clearly rates have gone much higher since then, but they've started to trend down. So that would be another thing. If you have some higher interest debt, be paying attention to where rates go in 2026. We see some changes on the horizon.
Yeah, and I mean, this could help people that got into homes with higher interest rates. Maybe they can refinance and get a lower rate going forward too.
Yeah. Now, what about those folks that are kind of in that great? They're just about ready to retire, and there's been some tax changes. Does it make sense for people to consider paring down how much they work?
Yeah, this is a good one. I had clients the other day. It actually makes a lot more sense for them to fully retire
Yeah.
than it does for them to work. And we all got a good laugh out of it because just the tax savings by him not working. He's working to pay taxes right now, and we could eliminate that and move forward.
Right. And then didn't you met with somebody who's working part time, and you said literally it's costing you money
Yeah,
to
it's
work part
costing you
time.
money. Like that's again going to the forward-looking tax plan. Like, hey, let's if you want to work and that gives you all the value and everything like that, then great. But if you can stop and let's pull the trigger.
Well, yeah, I mean, yeah, mathematically, with some of these changes because of one big beautiful bill, changes to the tax code, there's income thresholds that you got to just be careful not to cross
Mhm.
over. So there's absolutely reason to be paying attention. So if any of this was helpful, and if you're out there listening and you're thinking, "Wow, these are great strategies," but you don't know how to do this or how to execute this, or maybe you just have better things that you'd rather do in your life, if you need help with this, give us a call. This is what we do. We do it every day. We love what we do. We love who we get to do it for. So reach out to us and we're happy to see if some of these strategies can make sense for you too.
Thanks for listening. If you're watching us on YouTube, be sure to give us a like and subscribe. And if you want more info about the show or want to watch past episodes, you can visit us at navigatingretirement.net.